the best top-down analysis, training, and strategy. How to utilize the higher time frames and the lower time frames so you can make sense of your chart and make the best trading decisions. After this video, you're going to know how to combine multiple time frames to make excellent trading decisions. Understanding how time frames work will give you the biggest edge whenever you want more accuracy about market direction. The key is to zoom out and look at the bigger picture. Zoom out to the 4-hour, the 8-hour, the daily. You can allow yourself to look at the market from this higher perspective, and you're able to gather more data about what is really happening within the asset you are trading. This is the secret to find the best trading setups. Analyzing the bigger picture will help you understand the market much more clearly. In this top-down analysis, we first start with the higher time frame bias, which we're using the monthly, the weekly, the daily, the 12-hour, the 8-hour, the 4-hour. Then we go down into the entry time frames, which is the 30-minute, the 15-minute, the 5-minute, or the 1 minute, depending on whether you like to scalp trade or swing trade. You want to merge the higher time frame with the lower time frame. You want them to synchronize, to sync up. So whatever's happening on the higher time frame, you want the lower time frame to be in alignment with that higher time frame decision. This is how it works. You look at your higher time frames, monthly, weekly, daily, 12-hour, 8-hour, 4-hour, and you want to look at the Heiken Ashi candles. If you find yourself a higher time frame, flat back Heiken Ashi candle, this is a sure sign that there is a trend starting on the lower time frames. When you can identify your higher time frame correctly, trading on the lower time frame becomes super easy. For your lower time frame entries, you can focus on the 30 minutes, the 15, the 5 minutes, or even the 1 minute. Once we know there's a clear uptrend on the higher time frame, we come to the lower time frame. I'm on a 5-minute chart here, and we're looking for long entries every time there's a pullback. In order to master time frames, you need to accurately understand the forces behind these different time frame scales. This is how you will be able to anticipate the best setups. This leads to the biggest edge you could possibly have as a trader. Understanding time frames will give you insight to all the players in the market and the different time frames that they trade on. This will give you this predictive insight as to where the market is going next. But before I reveal how these time frames actually work, consider joining my Discord group where we give away crypto signals, forex signals. We share live training, how to actually trade the markets, how to win in the markets. And included in our signals, we also offer our unique ultimate smart money indicator. This is included in the package. If you want to find out more, go to our website, Smart Money Trader, and click on Signals or Indicator. The scale of market timeframes works like this. You have the slow big money, and they trade on the higher timeframes. The monthly, the weekly, the daily, the 12-hour, the 8-hour, the 4-hour. This is your higher time frame stability in the market. This is what helps you accurately predict the movement of the markets. And then you have the fast small money, which is the 1 hour, 30 minutes, 15, 5, and 1 minute. This is the lower time frame liquidity. Each one of these time frames consists different kind of time frame traders, which I will share with you now. First of all, to keep in mind, the market makers who drive and move the market, they trade on the higher time frames. So you want to synchronize and emulate their movements. This is why it's very important to pay close attention to your higher time frames. The big money, which is the stability in the markets, which determines the movement of the market. These consist of institutional traders, hedge funds, funded retail traders. They collectively make up the market moving class. The big money have a longer term approach to trading, from months to days, They move large amounts of money in and out of the market consistently. They must also consider available liquidity before executing a trading plan. It's not as easy for them as it is for the smaller money traders. They can influence the market with their large position sizes. Then we've got the small money, which is the liquidity in the market. This is the majority of the retail traders using short-term trading systems and strategies. They have a short-term approach to the market. From minutes to days, they trade smaller position sizes. Therefore, they do not have a big impact in moving the market. They're also able to trade the market with very low slippage and don't have much execution problems when entering and exiting their trades. To learn how to trade effectively, you must understand the slow and fast money in order to be able to accurately forecast future market movements. You need to think like the big slow money, even though you can't individually move the markets. Ultimately, to win as a trader, you need to base your trades from where the bigger money is flowing. That is where your best timing entries will come from. Here are examples of time frame representations. The 1 minute and the 5 minutes are mostly retail traders looking to capitalize on small market movements that usually last 5 to 30 minutes. Then we've got the 15-minute and 30-minute traders. These are also mostly retail traders and some institutional traders. Then we've got the 1 hour, 4 hour, and the daily. These are institutional traders looking for optimal trade placements for executing their large trades. Then we have the weekly and the monthly traders. These can be your market makers. They can represent the collective flow of the market, which provides huge opportunities. Understanding these time frames and the different traders who trade on them will help you increase your win rate and your belief and perception about how the market is actually moving. By basing your initial analysis on the higher time frame, you align your strategy with those who control and move the market. You don't want to trade against the market makers. You want to trade with them. Here are some examples. You've got the daily money movers, which are stronger than the 30-minute traders. You've got a daily chart. You've got this massive bullish candle on the daily, which shows long bias. Then on the 30-minute, you're looking for these pullbacks into the prevailing trend. Every one of these pullbacks would have been a long entry to catch the trend. By identifying these significantly trending moments, these turning points, you set yourself up to take advantage of potential low risk, high reward opportunities. These are the best of the best opportunities you can find. The weekly is more powerful than the 4 hour. So we can see we got a weekly massive bearish candle, which shows us that there's momentum going to the downside. The market makers want to drive the price down. We come onto the 4 hour, and every pullback up is a perfect opportunity to enter our short trades at the optimal places. You can enter over here, another pullback, another pullback, another pullback. There were many opportunities, and you will find many opportunities once you start to think this way. By analyzing the higher time frame, you can more accurately forecast an expected time fulfillment to each opportunity that arises. Because the daily time frame must continue to trend for our short trades to work out, you can confidently believe that this opportunity shouldn't take more than a day or two to follow through and put you in the money. So if you spot massive bearish candles on the higher time frame, these could be Heiken Ashi or normal candles. I prefer to use the Heiken Ashi, and we're looking for those flat backs as I explained in the beginning of this video. So using the higher time frame daily as your directional bias, you can see these massive bearish candles. So we come to the 30-minute, and we're looking for these pullback entries into this downtrend. You can use the master pattern as well. I have many trading videos teaching you how to draw it by hand. Understanding the different time scales will help you understand where the big money is flowing and help you plan accordingly to that. Short-term traders looking for shorter, smaller moves can look to the daily and weekly for perspective. If you clearly understand the direction of the weekly time frame, then you will be prepared for the majority of the big moves to unfold in the same direction throughout the trading week. Longer term traders looking for bigger moves lasting multiple days or weeks can look to the monthly time frame for perspective. The current direction of the monthly chart will show you the direction of where all the big money is flowing. By understanding this basic fact, you can anticipate massive opportunities that set up on the daily time frame in line with the monthly direction. Consistently profitable days come from trending weeks. Consistently profitable weeks come from trending months. If you stay disciplined to the trend long enough, then those weeks and months add up to a career. And to sum this all up, the higher time frame for buyers, we use the daily, 12-hour, 8-hour, 4-hour. For the higher time frame, the monthly, the weekly. And this is your higher time frame stability. This is what moves and drives the market. Then down here, we've got the lower time frame for our entries. We use the M30, M15, M5 minute for these precise entry points. This is the lower time frame liquidity. When we combine the higher time frame stability with the lower time frame liquidity, this is where we find our edge in understanding how time frames work. Let us now jump onto the chart so I can show you how this process actually works. So if you look over here, I've got the higher time frame chart over here because the higher time frame shows us the direction of the market and it helps us to trade in alignment with the market makers. And then on the right hand screen, I've got the lower time frame, which is our entry time frame. So let us focus on the higher time frame first. So as you can see over here, we've got our smart money box, which is from our ultimate smart money indicator. Once it prints a signal, we start to pay close attention. At the same time, look over here. This bar over here shows us the monthly Heiken Ashis, the weekly, the daily, the 12-hour, the 8-hour, and the 4-hour. And you can see over here, at this point where the signal was alerted to us, we go down here and we look on this higher time frame Heiken Ashi monitor, and it shows us most of them are green, especially the higher time frame. Look over here, when you've got the monthly and the weekly all green, you know that the higher time frame is steering the ship in that direction. So this is a major confluence. Then over here, this is our sweet spot when price breaks out of our smart money box, breaks above it, and you can see it's also a flat back bullish Heiken Ashi candle showing volume. This confirms to us that the market makers are moving the market upwards, and this confirms to us as well that the bigger players, the bigger money is driving the money upwards. Then we come onto our lower time frame. So we are confirmed that price is going upwards. We know that this is the direction of the trend. Then what we do is we wait for our smart money boxes to be created. These are an incredible indicator that lets you know before volatility is going to occur, and it shows you the best times to enter your trades. If we quickly go back to this chart, we can see that this was the exact point over here where we got the signal on the higher time frame to start looking for longs. So we come to our lower time frame chart. I'm on the 15 minutes for my lower time frame, and my higher time frame was the 8-hour chart. So here I am on the 15-minute chart. And what we're going to do, guys, every time we get a smart money box, can you see there's a smart money box, there's a smart money box, there's a smart money box, and there's a smart money box. These boxes are created when there's contraction in the market. There are many different strategies we teach in our Discord group, but the one I'm going to show you now is a very simple method. How you do it is whenever price breaks above the box, on a confirmed uptrend, you know this is your entry. Stop loss goes below the swing low, and you can either target liquidity lines or you can just let it run because we know we're on an uptrend. The second would have been over here. Price breaks just above this point. Stop loss can go below the swing low, but that would be quite big. So we'll just take it below this point. We can target a 1 to 2, or we can let it run until we get these big wicks. Whenever you get these wicks, it shows there's liquidations happening or reversal happening. And then we've got these other two options over here. So I'll draw a line over both of them because they're kind of the same. So as price gets above this line, we would have entered stop loss below swing low. That would have been the first one. But you can see we got a bit of a fake out, but we still would have been in a winning trade. And the second one over here, price below the box. And we can target liquidity line or until we get a nice wick liquidation. But this is basically how it works. We know we're on a confirmed uptrend because The smart money box on the higher time frame has let us know this box is a leading indicator, guys. It shows you before volatility will enter into the market. And the higher time frame Heiken sheet confirms to us price is going up. The big players want to drive price up. Then on the lower time frame, we come look for our precise entries. Every time we get these smart money boxes, a break above the box is the entry. Break above the box, entry, and entry. And you can see, guys, all of these would have been winning trades. This whole strategy is guaranteed to take your trading to another level.